Hello, this is Charles Zhao here from Doing Discovery. Welcome back. So last time we covered the first point on from finance perspective, how to avoid losing money in property investment. So today we're going to go through. So that was diversification. Today we're going to talk about opportunity cost. So we start with an analogy. So the question is, what do you ask when you're buying a company? So we use a concrete case study here. So Thomas Cook here. So UK based. So holiday makers. So they have airlines, hotels, tour operations. It's very much a integrated chain. So then I'll propose we ask a series of questions. First we ask, okay, what does it do? So Thomas Cook, holiday maker, have airlines, which is the travel part. They have the tour part. They have the accommodation part, and then it's a good company. Okay. But given there's so many parts in this company, it's probably a better question to ask, which part of it is good? Is it the flight part, or is it the resort part, or is it the tour operation part? And then a better question still would be compared to what? Okay, so between these different components, between your resort, holiday, tour operating, and your flight, you may say actually my tour operation has the biggest profit margins. But actually, a better question is, compared to the flight part, for example. But actually, compared to the industry, you may be underperforming the tour operation part, whereas that flying part, industry-wise, it may just be a lower margin industry. But however, your flight division may be performing above average. So in that case, you probably say you have a relatively bad tour operation business, but you have a relatively better flight operation business. Especially in economics, we call the comparison is very important. So this last part is what we refer to as opportunity cost. So by that, if we apply this concept of compared to what in this question onto the property investing, so here, let's say in front of you, you could do a large project. It would take you 4 years, large project from land build, and it will give you certain margin. Let's say it will give you 20% return on cost and net. However, the alternatives could be, you could do 4 sets of small projects, each takes a year. So in have land building, now you're doing conversions, or you're doing flips, that's even shorter. Each of these could give you, let's say, 10, 15, 20% margins. So then the question is kind of, how do you know whether the deal in front of you is a good deal? Then, falling back to economics and to our previous analogy, the question we'd ask here is compared to what? So if you have 100K, a million, 10 million, so where do you want to deploy it? Then it comes down to, okay, what options do I have? So what's my first best option? What's my second best option? So then it's really the comparison between those two. So essentially, you either deploy money here or there, or you can deploy using a spread, so diversified method. So then, if you look at these kind of typical comparisons between large projects and smaller projects, and their benefits and drawbacks for each type. So, for example, if you purely look at financial returns, the large projects, you may say to a certain extent, especially if you're building over a housing estate or 30 different houses, you may have more flexibility in the construction. So if something happens, you can delay, you can speed up, you can build in a different order. So you have more room to maneuver. And if there's any cost overruns in any one particular plot, because you have so many plots, it's easier to absorb that cost overrun. However, equally, what you can have a problem with is if you do, in our example, instead of one big project taking 4 years, if you do 4 little projects, then between the project, you actually compound your money. So not only all your money, your 1 million went into the first deal, and by the time it exits, you can have, let's say, 1.2 million, which then goes to the second deal, then you're going to have 1.4 million. So there's this compounding effect. And then in addition, what tends to happen is with larger projects, and it very much depends on the project. A general trend, at least I've seen, is for a lot of the larger projects, it's difficult to drive a very high margin. So margin tends to be higher when there's smaller projects, and also when it's compared to large projects. Because once it's similar with companies, once it's beyond certain size, you start to lose that profitability. With that, to some extent, because the lower margins also imply lower margin of safety. It only takes kind of on aggregate, let's say if you're making 30% profit, then you can afford for things to go wrong to 20, 25%, you still make some money. So you still come out profitable. However, if you only start with a 20% or 15% margin, then only a few things need to happen before it would put you into the red. Complexity, this is a great dimension for me to think about is not all deals are the same, because they are large, simple deals. So for example, if you go to Ireland, say if you're building a housing estate of 30 houses, it's almost like 30 individual one house projects. So it's large, but it's simple. Whereas let's say if you're building a 300 unit block of flats, and there's like this fancy design or slope to the ground, so there are different things that could mean, for the similar size. So for size, I think similar GDVs, the complexity of the project can be very different. And in general, my personal preference is always you go for the simplest build. So you may be extraordinarily capable of delivering complex projects, but I would say, hey, like why risk it? So usually people who are most capable, they become more aggressive, more confident, then they can take on tougher problems, and that's where it go wrong. So just again, sort of taking after Buffett, he would say, pick the 1 foot bars to step over. Yes, you may be a great high jumper, you may have a great pole with you, but why go through the risk? Why go through the trouble? So complexity is also great to me. Is a great criteria to measure that compared to what against. And then the last one is and this is a common problem we see in today's investment market. So what happens is, if you look at the past 10 years, so you have historically, this is essentially a once in a lifetime low interest rate environment, right? So essentially we're coming next to nothing, now it's small recovery, but if you look at the bigger picture, essentially rates are floored at zero, effectively. So then what happens is you have traditional investment methods, if you look at ISA, for example, so the kind of term savings, regular saving, term fixed saving, and ISA, these kind of what's available to the public. But the problem is they're now giving next to nothing returns. And then you have such as crowdfunding will come in, alternative investments will come in. People will start to say, hey, why would you put your money in the bank earning half or 1% when you can give your money to me? I can to give you returns of 10-20%. To me, it's assuming the people are marketing this in an ethical way, meaning that they're not targeting the general public. They're really going after qualified investors, which have the ability to judge, to evaluate the proposal. To me, it's fundamentally inappropriate to compare these two different investments together. For example, fixed rate savings or ISAs versus property investment. So these are yes, it's an alternative option, and it's a high yield alternative option. However, I would say they're not really comparable, because if you look at the risk profile and the how things can go wrong, and then the volatility in expected returns, right? So if you regular saver 2%, 3% a year, you will get that unless the bank goes bankrupt, in which case the regulator will step in, will still pay you that. So whereas it's very much a different story with if you invest in a developer and the developer goes bust or the project goes wrong. So here I would say be very mindful when you're considering different options. It's okay to consider alternatives. However, at least for me, it's worth to keep in mind alternative does not mean it's comparable. These are not like flat. You cannot say everything else is the same, but returns like that, so therefore I go with this option here. That's not how I would approach the problem. So here again, this is somebody I know personally. So this is an investor who bought offline ventures in 2006. So this is pretty much the peak of the market back then. As you can imagine, it's a 2-year offline deal. So once he got it in 2008, he's immediately in negative equity, because at that point the market already crashed. However, what he had was he had sort of this holding period where rates were low, so he managed to rent it out. So he has this ongoing income stream. And then back 2016, so 10 years after he bought this thing off plan, he's now back into positive equity. So if he wished to sell now, he will sell for a higher price than he bought it for. Then when I was speaking to this person is, to me, to him, the deal worked. So he didn't lose money, and then he had an ongoing revenue stream. Right now he's in the value is higher than the price he paid for. For me, when we reflect our own investment performance, it's very important to find a suitable benchmark to compare against. Is if he compare, let's say this money, let's say it's just cash in his hands, So if he started with 1 million and he look at this 10-year period, at the end, technically he now has more than 1 million, so he made a gain in that deal. So if you compare this deal's performance against cash doing nothing, then yes, he made money. It's a good deal. However, if you compare this against some other alternative ways to deploy that 1 million, then this may turn out to be very inferior. So for example, so this is a off-plan new build purchase. What if he bought secondhand, right? So if the real income in this structure is that 10-year of rental yield against a essentially non-existent, so a very low financing cost, then you may as well buy cheap. So what if you bought secondhand, or what if you bought something else that is counter-cyclical? So there are different alternative investments you could buy, which should give you is going to give you much higher return. So from that perspective, if you evaluate yourself on that way, so not compared to cash, which is how most people. It's like most people compare action against inaction. So in this case, action is I went into this deal. Inaction is I hold this in cash. And they said, and then they kind of come out positive and say, okay, this is a great thing. I will keep doing it. That's the working strategy. I would encourage you, as something I remind myself as well, to compare action A to action B. As in, if I don't buy this, I may go into some other investment. What's the relative outcome of the two options? And then you reflect. Because in reality, it's never of, I either invest or I don't invest. It's really the question is in general, do I invest in A or B or C? So therefore, I propose, when you reflect on performances, which I highly recommend you to, it's better to take that opportunity cost lens. So you always ask the question of compare to what. Okay, so that's the second point on financial risks. So next time we will go through point number 3, which is profits versus cash flows. Okay, I'll see you next time. Bye-bye.